All right, so it's that time of the year when you should be focusing on your tax saving investments. But as we all know, in this last minute planning, a lot of time investors land up buying investment instruments where they just get the tax benefit and otherwise no other financial portfolio benefits which are or which should be aligned with their financial goals. So let's decode this tax saving investment strategies today so that you don't land up buying wrong products. In fact, what are the right kind of investment products which you can align with your financial goals and also have a tax saving benefit out there. I have with me Preeti Khurana, independent tax expert. Preeti, good evening and welcome to the show.
Thank
So
you.
it's a last minute rush, you know. It's the new year, and Jan is still a comfortable time when you should be planning or putting in your money in tax saving instrument. You know, if someone wants to do it in March, I think that is just it's just too last minute to plan these kind of investment. In fact, when you talk about having tax saving investment in your portfolio, this should be done in the beginning of the year or in beginning of the financial year. Well, again, we'll be coming up with this edition in April for our viewers. But then let's talk about the kind of tax saving investment instruments that you might want to opt for if you are an older tax structure employee or someone who's opted the old tax structure, because now considering we have two type of tax structures, in the new one you really don't have much of tax benefits, right?
That's right, Kavita. And I'm glad you raised this very important aspect that now is the time to do all of your tax savings. If you haven't yet given thought to, saving taxes or, depositing money to whatever financial product it is that you want to opt for, now is the time to do so. And I'm sure all of those who are salaried would have received at least some intimation from their employer requesting that, they submit the tax proofs. However, I just want to remind all the viewers that even though you have time until March, the benefit of submitting tax proofs to your employer is that TDS can be deducted accurately. So, if you wait until March, or, you claim your tax deductions at the time of e-filing, then you may have to seek a refund. So the benefit of submitting all your tax proofs in the month of January, or whatever is the deadline issued by your employer, is that all the taxes are taken care of by the employer itself. So then you don't have to worry about, whether there is a refund or you have to pay extra tax or whatever. So make sure that not only you think about what are the tax saving options you want to opt for, but you do them well in time so that you're able to submit the proofs to your employer and your TDS has been deducted accurately.
All right, so this is something, you know, a little bit of homework that you all need to do. But then, what kind of tax saving instrument should you be going for? You know, a lot depends on the kind of understanding you have of an investment product. You know, typically, if I want to talk about the old tax structure where you still have the ATC, where you can save 1.5 lakhs. So, what kind of investment instrument products, according to you, should be first on your radar?
Absolutely. So, as you rightly mentioned, that there is an old tax regime and a new tax regime. Now, both these regimes are slightly different from each other. While the new tax regime offers lower tax rates, it is under the old tax regime that you will be able to claim various deductions, such as deduction for HRA, LTA. Then you have all the Chapter 6A deductions like ATC. Then you have ATD for medical insurance premium. Then you have deduction available on savings account interest, which is under ATTTA. So there are a host of deductions which are available in the old tax regime. Now, choosing an investment product essentially is a factor of, what is your risk profile? For how much time are you willing to park your funds? For example, under ATC, you can reduce your taxable income by 1.5 lakhs. And ATC has various products. So it'll have life insurance premium. Then you have ELSS, which is equity linked saving scheme. It's a kind of a mutual fund. Then you also have PPF, which is public provident fund. Now, these three are the most popular. You even have ULIPs, which are eligible for tax deduction. So you have these 3-4 products which are hugely popular. But what should you choose depends on how much time you're ready to stay invested and what kind of returns you're looking at. So mutual funds, as we know, markets have been doing really well. So mutual funds have been offering phenomenal return, and ELSS is equity linked, and the minimum time period you need to stay invested is 3 years. However, it's always beneficial, to look at like a 5 year or a 7 year horizon at least, to truly benefit from investing in such a fund. Now, if you want to do something which is, more secure, risk free, then you have the option of going for PPF, which is Public Provident Fund, and you can invest up to 1.5 lakhs. The entire eligible amount or whatever portion you want to go for can be parked in PPF. You will get tax-free returns. However, you'll have a very long period of lock-in, which is 15 years. You may be able to withdraw if there's an emergency after 5 years. Then there are situations in which people are allowed to withdraw. But essentially, that's the product we are looking at for a very long term point of view. Now, ULIPs have also become very, very popular because these can be opted for when you're looking at meeting a specific goal, and therefore it's important to understand what is the nature of the product, how much investment you do need to do on an ongoing basis, because usually you have to make regular payments. Similar is life insurance premium. So if you're going for life insurance, then understand the policy, see what are the benefits, see what are the claims like, and only then opt for this kind of a product. So that's ATC, and all of these deductions are only available in the old tax regime. So if you opt for the new tax regime, then you will, of course, have lower tax rates. You may have a few deductions, which is one is on, the benefit you get on standard deduction, which is 50,000 available under both the regimes, and NPS is another interesting product. So if you have opted for national pension scheme, then you might be able to claim the employer portion in the new tax regime, whereas in the old regime, both employer and employee contributions can be claimed as a tax benefit.
So, Preeti, tell us something. If one wants to opt out from old tax regime and want to come in the new tax regime, that can be done only in the beginning of the new financial year?
Well, actually, what they have said this time is that the new tax regime is the default regime. What that means is that usually for most of us, our employer would have sent sort of a request saying that, which of the regimes do you want to opt for? And if you fail to opt for one, then either one, then they might have chosen the new tax regime for you. However, that's not a very big challenge. You can always request the employer, or at the time of filing your tax return, if you are salaried, then you have the choice of switching to a more beneficial regime. So when you are preparing your tax return, just see between the two regimes, where do you end up paying lower taxes, and you shall be allowed to make that switch. However, several employers have also, what they have done is that they have automatically selected the old regime for you if that regime was more beneficial to you in terms of your tax outgo. So if you had a lower tax outgo just by virtue of being in the old regime, then several employers have actually continued with that. But that is something that you essentially don't have to worry about. Just make sure that whatever reimbursements you are eligible to claim, if you have any, sort of bills or telephone bills, broadband bills, or if you have any other kind of reimbursements, perquisites which your employer offers you, make sure you submit those bills on time, because those cannot be taken care of at the time of filing your tax return. And irrespective of whichever regime you are in, I think it's high time that investors start looking at products like PPF and ULIPs and insurance premiums as part of their financial planning and their financial investments, irrespective of which regime they end up opting for.
Preeti, what according to you is one of the tax benefit that goes missed? You know, a lot of times we come to realize that people forget to claim tax benefit over their health insurance, over their critical health insurance as well. So, according to you, what are those investment categories which you have invested in during the year, but then you forgot to claim it as far as your ATC or ATD is concerned?
Right. I think that's a very valid point. So, what has happened is that over the past few years, not everybody is maximizing Section 80C. Now, what the government has said is that more and more people are opting for the new tax regime. Now, why exactly is that happening? If if for a lot of taxpayers, if they have funds available with them, and if they maximize the benefits under various sections, then in many scenarios, the old regime should prove to be more tax beneficial. So my suggestion would be to all taxpayers to actually review their tax calculation statement. You should be able to access it through your employer on your intranet, or whatever mechanism is being used. And on that tax computation, see if you have maximized your ATC. Now there may be a scenario that you may be assuming that because you are depositing to your EPF and that will take care of ATC, but it does not. So if you're leaving anything on the table in terms of not maximizing that 1.5 lakhs, then see where the gaps are and go and claim those. So far as health insurance is concerned, many a times when you opt for health insurance for your parents or in-laws through your employer, then you may have to shell out a certain extra money to your employer. That also you can claim in your tax return. So if you've opted for a health insurance premium, then you're eligible to claim a tax benefit under section 80D. You can also claim if you have insured your parents, so that also you can be careful about. The other important thing, and I think I already spoke about it, but I just want to reiterate that if you have any claims that shall be sort of paid for or reimbursed through your employer, then please make those claims and submit the claims, because ultimately you might get that money but you might end up paying tax on it. So if that's a part of your CTC, then make sure that you have submitted the claims and you have received the money for those, and that's how you can save some extra tax.
And I think with that, it's time up on the show as far as this segment is concerned. Preeti, thank you so much for being there for our viewers and helping out with their tax saving strategies today. On that note, let's take a quick break, and post that, let's focus on our viewer queries. And I'll be joined by Gautam Kalia, who will be taking up live questions from our viewers after this break. Welcome back to the Money Show. I'm Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? Today I have with me Gautam Kalia, Senior Vice President, Head Super Investor at Sharekhan by BNP Paribas. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 8657974571. You can also email us your questions on the Money Show at etnow.tv. Hi, good evening, Gautam, and welcome to the Money Show. And I'm also joined by our viewer from Chennai, Mr. N. Raghupati. Good evening, sir. How are you doing? Thank you so much for sending us your question today.
Good evening, sir. Hello.
Sir, I think you had a question regarding, good evening, sir. I think you had a question regarding SBI Retire Smart Plus scheme.
Yes.
Did you try getting in touch with them via their customer care?
No, madam. Till now I have not done anything.
Okay. What exactly is written in your policy documents? Any clarity over there? Did you get it checked?
No.
Okay, I think I'm not able to get the audio correctly, but then I have Gautam with me. Gautam, so SBI Retire Smart Plus scheme is what he's opted for, and if the money is invested in some kind of a pension fund, he wants to know what exactly is the breakup and how exactly is it invested. Although all these details he should be having before putting his money in this kind of a product, but then for Mr. Raghupati and for other viewers as well, what kind of retirement scheme are we talking about?
Yeah, so typically you have different types of retirement schemes. And this is the kind of scheme which you want to invest in when you're in your 40s at the latest, so that by the time you retire, you have kind of developed a corpus. But Mr. Raghupati is a retired central government employee, so he's already retired. So this is essentially a unit-linked investment plan of SBI Life. And the idea is that you invest and take exposure to debt and equity market over time. Obviously, you have the life insurance element as well to protect you. So it works as a typical ULIP where you have to invest over a period of time, and then you are able to build a corpus over 10-15 years. It's slightly on the costlier side because you have fund management fees as well as administrative fees in addition to the cost of the life cover. So what I would say is, because he's looking to get an understanding of what his investment value is. So for that, he'll probably have to go to the website and use the policy number to log in. He would have received a policy document, and he can create his login and get updated on the value of his investment through that, and probably even change his investment allocation between equity and debt. So the SBI Life Retire Smart is basically one which has three different types of funds within it. One is the money market pension fund that has delivered a 6.3% return over the last 1 year, which is slightly lower than the benchmark of 7.1. The equity pension fund 2, which has delivered slightly above the benchmark at 20.7% return over the last 1 year. And the bond pension fund 2, which has delivered about 6.2%, again lower than the benchmark at 7.1. It is basically a ULIP designed to create a corpus over a period of time, and you have loyalty additions that are payable every year starting from the end of the 15th policy year, and there is a terminal addition of about 1.5% of the fund value. So obviously he has access to be able to access the funds in case of emergency, but otherwise typically the lock-in of such products is about 5 years.
All right, I think that sorts out Mr. Raghupati. Mr. Raghupati, quickly, I'm actually done with my time on the show. Is there anything else you want to ask Gautam? Okay, I really did. I think there is some network issue out there, but then if at all there's something that you've missed out, you can watch the show on our YouTube channel as well. And with that, I think it's time up on the show. We could just take one query today, Gautam. Thank you so much for being on the show and helping our viewer with their financial investments today. On that note, it's a sign off on the Money Show as well, but then I'm going to leave you with our WhatsApp number and our email ID. Also, if you watch us on YouTube, where we are also live, you can send us your question on the comment box and we'll include your questions on the show. Thank you so much for watching. Goodbye.